Welcome everybody to the course of mutual funds. We will be first discussing the concept of mutual funds. We would be first understanding the financial market. Now, financial market is basically a tool or a medium for allocation of funds to savers and to the lenders. Many a times it happens that the savers want to invest their money. Where they will invest? They will invest in the financial market. This financial market will help them to invest and will help them to gain returns. Similarly, many a times it happens that there are lenders who want to borrow money. Now, where will they borrow it from? They will have to borrow it from the financial market. Thus, it happens so that a financial market is said to be well working or efficient whenever the cost of saving is attractive for the savers and the cost of borrowing money is attractive for the borrowers. This financial market is further divided into money market and in securities market. Now, money market is organized and unorganized. An unorganized money market are nobody but they are money lenders who give money without any securities. An organized money market would be money markets or used in short-term lending who are basically banks, etc., with these transactions are basically recorded. Now, a money market is basically a liquid market wherein there could be a fast transaction of money to the people who basically require it. Now, secondly, it is securities market. Now, this security market are further divided into two parts, that is the primary market and the secondary market. Primary market is basically a market wherein the issuers are directly in contact with the investors. Now, these are used to raise fresh capital from the investors. For example, a share A or a company A wants to get listed in the stock exchange. Now, it has to raise an IPO, that is initial public offering. So, to raise an IPO, wherein he needs to get money from the investor, he has to use the primary market. In this case, he will be indirectly in contact with the investors. Similarly, in case of mutual funds, a mutual fund wants to raise an NFO, that is a new fund offering. Now, for new fund offering, they have to use the primary market wherein they will be having a direct contact with the investors. The investors will be giving them money directly. Now, once it is traded in the primary market, it comes down to the secondary market. Now, in secondary market, basically, it's the contact between one investor and the another investor. And this transfer of funds, that is a series of purchasing, selling, happens with the help of an exchange. This exchange basically allows an easy transaction of funds between one investor to the another investor. It has to be very important that secondary market forms a huge corpus of money, and this secondary market is the one which drives the primary market. Now, the components of the primary and the secondary market are equity shares, then they are debentures or debt instruments, and thirdly, mutual funds, exchange traded funds, derivatives, which are nothing but futures and options. Now, let us move to mutual funds. Mutual funds are nothing but they are a vehicle to mobilize funds from investors to invest in different markets. It is basically a pool of funds which is basically chosen by the investor in discussion with the fund manager, and it is then invested in different markets. Now, in this case, the investor has the choice to discuss the financial capability, his investment objectives. The investor knows his investment objectives. Suppose an investor wants to invest in a mutual fund with an objective of growth. So he can particularly choose that fund, and then in discussion with the fund manager, he can then invest in mutual funds. As I said, investor basically discusses with fund manager and then they get invested in mutual funds. Thus, mutual funds offer professional fund management services by assets under management. These are basically total assets which a fund manager basically manages or a company basically manages. Thus, as in such, it becomes a great tool to access the market which otherwise may be unavailable for the investors. For example, an investor may not have the knowledge of selling or buying in derivative market, or he may not have the knowledge of actually selling or buying a security. So he can basically contact a mutual fund manager and get invested in a mutual fund with investment objective in mind. So that's the concept of mutual funds. Now let us show some statistics. This is the statistics of UK, AUM statistics of UK, assets under management statistics from 2002 year to 2017 year. In 2002, the assets under management were somewhere around 1500 billion. In 2007, it was somewhere around 3200 billion. In 2012, it was around somewhere around 6000 billion. And in 2017, it was around 7500 billion. Now let's look at the rise. Just look at the percentage rise. Also, there are other statistics, AUM per GDP ratio, the assets under management versus the GDP, the contribution of the assets under management versus the GDP. It started from 50%, now it is, in 2017, it is around 400%. Now just imagine the growth of mutual funds in the market. Now this evinces us for the new slide, that is the mutual fund's role in financial paradigm. Now, what does mutual fund do? Why it is important in financial paradigm? That's the question. The first important part is the wealth maximization. An investor wants wealth maximization. He wants that the money that I invested in the market should give me growth, should give me returns. Thus, the major role of mutual fund in financial paradigm is the wealth maximization. It helps to raise huge corpus of funds to invest in various securities and markets. Now, mutual funds, they have a lot of assets. There are n number of AUMs. This basically forms a corpus of fund which can be used in securities, which can be used in debt markets and many other markets. It can be also used in project financing, etc. Similarly, this gives an access for a lot of other projects, for funds to a lot of projects, which helps in overall development of economy by mobilization of funds from a pool of investors to the market in a structured manner. Now, overall economic development projects will ensure employment. Then nextly, mutual funds basically help in market stabilization. As I said, mutual funds help in market stabilization. Mutual funds basically give access to a lot of FDIs, that is foreign direct investments, which help in market stabilization. When the prices are low, it gives access to a lot of foreign direct investors to basically invest in mutual funds so that the prices become stable. And similarly, there are selling and buying of funds, which helps in overall market stabilization and for the investment of foreign funds.